Earnings beat at Delovio 62 per share versus the $1.58 consensus.
Right, but a slight revenue miss, coming in at $2.17 billion against the $2.19 billion expected.
Yeah, yet management actually reiterated their long-term algorithm, that 5% unit growth and 8% core operating profit growth.
Which is probably why the stock popped 4.6% pre-market, hitting $159.
So what happens when a fast food giant misses top-line estimates, but the market cheers anyway? Well, that is our mission for you in today's deep dive. We are pulling from your financial notes and the latest earnings transcripts to figure out what this newly streamlined Yum! Brands portfolio actually means for you.
Well, the surface numbers look a bit mixed, but, digging into your notes, the market is clearly reacting to a massive structural pivot.
The Pizza Hut sale, right?
Exactly.
Yeah.
Yum! Is officially offloading Pizza Hut for $2.7 billion in two separate transactions.
Right, to Yum China and Long Range Capital. Well, I'm looking at these Pizza Hut numbers from the quarter, and sales are down 2%. Operating profit dropping 12%. I mean, I get wanting to get rid of a drag, but help me understand the mechanics here.
Sure.
Like, how does offloading a massive legacy brand actually fix their core growth algorithm?
I mean, think of it as uncoupling a heavy, dragging freight car from a high-speed locomotive. Pizza Hut was just burning fuel.
Like management time and capital.
Yeah, heavy capital expenditures, and it wasn't matching the speed of their other brands. So by dropping that dead weight, they net $2.3 billion in proceeds.
Wow. So that cash just acts as a direct accelerant.
Right. They are aiming it right at debt paydown and funding a massive new $4 billion share repurchase program.
Okay, so for you tracking this stock, the takeaway isn't just that they sold a pizza chain. It's that they are basically doing a corporate pruning.
Pruning is a great way to put it.
Right. They cut off a struggling low-margin branch so they can use the proceeds to bulletproof the balance sheet, and artificially boost future earnings per share through those buybacks.
Exactly. And they are reallocating resources to where the margins actually are. Taco Bell completely carried this quarter.
Did they ever?
Yeah. Same-store sales jumped 7%, and their U.S. margins expanded by 170 basis points, which brings them to 26.2%.
That is huge.
Mm-hmm.
And KFC is pulling its weight too, right?
Yeah.
System sales up 6%.
Yeah, they really are.
Okay, well, here is where my notes get really interesting. Across these core brands, the digital mix exceeded 60% of total system sales.
Which is a massive shift.
It is. But I've got to push back on this digital growth narrative a bit, specifically for Taco Bell, where the digital mix is at 47%.
Yeah.
I mean, in a drive-through heavy business, haven't they hit a ceiling?
Well, it depends on how you look at it.
Like, how much higher can that realistically go before you just run out of people willing to use an app for a drive-through order?
If you view digital as just, a different way to place the exact same order, yes, there is absolutely a ceiling. But that kind of misses the underlying mechanism of their proprietary Byte AI platform.
Byte. So it's not just a digital menu.
Right. This isn't about just replacing a cashier with a screen. When Taco Bell routes an order through Byte, they capture all that consumer data.
Oh, I see.
Yeah, they use AI to analyze purchase history and trigger targeted, personalized offers. It is designed to turn an occasional drive-through visitor into a weekly recurring revenue stream.
So they are essentially manufacturing higher ticket sizes
Yeah.
and visit frequency.
Exactly.
But, it's easy to look at that digital ecosystem as a massive win until it gets its ultimate stress test.
Right, the supply chain.
Because all the data in the world doesn't stop a physical supply chain crisis.
Yeah.
Which brings us to the mid-July Cyclospora food safety outbreak linked to their lettuce supply.
Yeah, that outbreak severely impacted Taco Bell. I mean, Q3 quarter-to-date same-store sales are already down 2%.
Right.
And management guided Q3 restaurant margins down significantly, targeting between 19% and 21%.
See, there is a real tension here in the transcripts. Management claims social sentiment has already recovered.
They do, yeah.
But looking at that margin compression, the reality is they are heavily relying on their digital ecosystem to engineer foot traffic. Like, they are doing things like dropping $1 Mexican pizzas on the app to artificially buy back customer visits.
Right, and that margin hit is just the cost of utilizing targeted app promotions to basically override a food safety headline.
So they are paying to make people forget.
Exactly. They are sacrificing short-term profitability to force customer re-engagement through their loyalty program.
Which leaves you with a fascinating question to ponder as you review the rest of this earnings report.
Yeah, absolutely.
If a fast food brand can weather a major food safety crisis almost entirely by leveraging targeted app promotions and digital discounts, does brand trust in the modern era simply equal digital convenience and cheap value?
It is a great question. question.
Right. Is loyalty just a $1 Mexican pizza away? Well, we will be back tomorrow to dive into your next stack of sources for your daily earnings coverage, keeping you ahead of the market one report at a time.